All right, let's look at Ondas Holdings, ticker ONDS. The U.S. markets are, of course, closed for the weekend, so we are looking at the final closing print from Friday, November 14th, 2025. And what a session it was. The stock finished at $7.18 per share, a massive move up of 62 cents, which is a 9.45% gain on the day. The volume was simply enormous, trading over 184 million shares against an average of just a fraction of that. This wasn't a quiet drift up. This was an explosion of interest and an event that demands our attention. Now, the immediate expectation, seeing a 9.45% pop, is that this small-cap tech company just hit the lottery. You see this on your Robinhood app or your SoFi Invest platform, and it looks like a rocket ship that's finally leaving the launch pad. The narrative for ONDS has always been this compelling story about drones, secure networks for railroads, and high-tech government work. The expectation is that this 9.45% move is the market finally waking up to that story. But here is the reality, and it's so much more specific than just waking up. That 9.45% jump wasn't based on a vague future promise. It was a direct, explosive reaction to the company's third-quarter earnings report, which fundamentally changed the numbers. The reality is that Ondas just reported a staggering 582% year-over-year increase in revenue. But the deeper reality is that this explosive growth comes with a completely new set of questions and risks. This wasn't just hope. It was the market trying to frantically reprice a company that just transformed itself. And the tension between its new revenue numbers and its continued massive cash burn is the real story. Let's establish the common ground because the excitement is understandable. When you look at Ondas, the story is fantastic. It's really two companies in one. First, you have Ondas Networks, the legacy business. This division is built on its proprietary FullMax technology, a wireless platform that operates on the licensed 900 MHz spectrum. The big prize here has always been the Class 1 railroads, which need ultra-reliable, secure networks for their critical operations, like positive train control. This is a slow, methodical, long-term infrastructure play. But the part of the business that is causing all this noise is the other half, Ondas Autonomous Systems, or OAS. This is the high-growth, high-tech division built through a series of aggressive acquisitions, including Aerobotics and, more recently, Apiro Motion and Centrix. We're talking autonomous drone-in-a-box systems, advanced ground robotics, and sophisticated counter-drone technology. The expectation is that ONDS is building a fully integrated system of systems for defense, public safety, and critical infrastructure. It's the kind of story that gets investors dreaming of NVIDIA stock-like returns. But this is where the popular narrative gets it wrong and where so much online investment analysis falls short. People see 582% revenue growth and drones, and they think the company is suddenly printing cash. The reality is that the Q3 report, while impressive on the top line, also showed operating expenses nearly doubled to $18.1 million for the quarter. The gross margin was only 26%. This is not a high-margin software business like Apple stock. It's a complex, capital-intensive hardware, integration, and engineering business. The 582% revenue growth to $10.1 million was almost entirely driven by these new acquisitions, the OAS division. This is inorganic growth. That's not inherently bad, it's a valid strategy. But it's not the same as a company like Tesla stock scaling its core product organically. The 9.45% pop on Friday was the market cheering the success of this acquisition strategy, a strategy they funded by raising a staggering $855 million in 2025 through equity offerings. So the reality isn't that Ondas magically found a new gear. It's that they used a mountain of new cash to buy a new gear. Let's dig into that recent action because the Q3 report is everything. That $10.1 million in revenue, up 582%, absolutely crushed estimates. But even the bigger news, the fuel for that 9.45% fire, was the guidance. Management raised its full-year 2025 revenue target to at least $36 million, and for the first time, they issued a preliminary 2026 revenue target of at least $110 million. That is what the market is pricing in. The narrative has now shifted. This is no longer just a small-cap railroad play. The company is now guiding to a 9-figure revenue run rate. This is what brought in the big players. This wasn't just retail investors doing some self-investing. The institutional filings show that massive players like Citadel, Two Sigma, and Hood River Capital have been dramatically increasing their positions. When you see 184 million shares trade, you're not just watching people on the Fidelity mobile app, you're watching a fundamental reallocation by major funds. These institutions, using sophisticated platforms like Interactive Brokers, are making a calculated bet that the $110 million target is not just achievable, but perhaps even conservative. They've done the math, they've looked at the new acquisitions, Apiro for ground robots, Centrix for counter-drone tech, and they believe this system of systems for defense is the real deal. And this is why analysts at firms like Oppenheimer just upgraded the stock to outperform with a $12 target. So let's be perfectly clear about the business model as it stands today. The ONDS networks, or ON division, the railroad-focused part, is still the long-term patient bet. The earnings call confirmed they're making progress. The industry's wireless committee officially blessed the 0.16T standard as the upgrade path, and Ondas is deep in pilots with multiple Class 1 railroads. But the revenue from this is still in the future. The present is all about Ondas Autonomous Systems, or OAS. This division is selling hardware and services right now. They are selling Iron Drone and Optimus drone-in-a-box systems for security and inspection. They are now selling ground robotics from Apiro and counter-drone tech from Centrix. This creates a multi-layered offering for defense and homeland security clients. The expectation is that a single customer, say a military base or a border patrol unit, can now buy a complete security solution from Ondas: ground robots for patrol, drones for aerial surveillance, and counter-drone tech to protect the airspace, all potentially linked by Ondas's own secure network. This is the full stack thesis that has the bulls so excited. And it's why analysts at firms like Oppenheimer just upgraded the stock to outperform with a $12 target. So now we get to the future outlook, and the tension between expectation and reality becomes razor sharp. The bullish expectation is that this all works. The $855 million they raised provides a massive cash runway. The acquisitions integrate smoothly. The company successfully scales production to meet the demand that management clearly sees, leading them to guide for $110 million in 2026. In this scenario, the OAS division becomes a high-growth defense tech powerhouse. And as a sweetener, the Ondas Networks division finally lands its first major Class 1 railroad contract, turning on a spigot of high-margin, recurring software and network access fees. If all of that happens, $7.18 will look like an absolute steal. This is the investment thesis that buyers on Friday were piling into, whether through an individual brokerage account at Fidelity or a sophisticated Interactive Brokers trading setup. But the reality check is just as potent. The risk is execution. This company is trying to do a lot, all at once. It's integrating multiple, complex international acquisitions while simultaneously trying to scale production and crack the notoriously slow-moving railroad industry. The 26% gross margin is thin. The operating expenses are high. They are burning cash, and while the $400+ million cash balance they reported is huge, it will dwindle if they can't get those margins up and scale efficiently. The bear case is that the $110 million target for 2026 proves to be wildly over-optimistic. The acquisitions become a quagmire of integration problems, and the railroad contracts remain just around the corner for another 3 years. In that case, the company will have to raise cash again, further diluting shareholders who bought in at $7.18. This is the risk you take. This is not a stock for a managed Schwab Intelligent Portfolios account or for someone looking for investment help with their retirement. This is not a stable Fidelity ETFs holding. This is a high-stakes, speculative bet on a very specific, aggressive growth story. So this brings up the most important question, the one that $110 million target hinges on. I want to know what you think. Comment below. Do you think Ondas can actually hit its $110 million revenue target for 2026? Or is this just acquisition-fueled hype that will be impossible to scale profitably? Let me know your take, because that one number is the difference between this stock being a huge winner or a major disappointment. So to wrap it all up,